equity, mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce.
That's good.
I am in so many minds about this episode. I am beaten down. I've lost this competition year after year that I can't even muster the energy to say that I'm excited for this episode.
Wow, that is a world first.
This is
world first. That's because we're doing Stock of the Year.
Yes.
Traditionally, an episode that you put a lot of time and energy in and great research. 10-cent pitch last year was epic, and unfortunately, your stocks seem to have a lag on them. You pick them, they don't perform so well, and then in the following years, they tend to do well. It'll be interesting to see how 10-cent goes this year. Could go really well.
It could.
But we're wiping the slate clean.
Yep.
And it's a new year, 2022. We've both got a stock.
New year, new you.
New year, new us. And you're incredibly excited. You've been pumping up this stock. I don't know what it is.
Yeah,
I'm really excited to hear.
I do. I am actually quite excited to talk about this company. The approach that I took after being in my own head about how am I going to beat Bryce, how am I going to pick a stock that doesn't lose a third of its value in the year that I pick it? And I was like, oh, do I just do the S&P 500 index? And then I was like, nah, that's boring. Like that one, that won't be a good episode. And two, it's not in the spirit of the competition. And then I was like, do I just pick a super safe, like an Alphabet or a Microsoft, like a company that just
plugs away.
Yeah. And I was like, no, you know what? I'm going to bring to the table a company that I just find interesting and that I would enjoy talking about for 15 minutes because let's be honest, I can't do any worse than I've done.
Fair point.
And if it goes up, if it goes down, at least I'm bringing a really interesting company to the table that I don't think you will have heard of before, but I think is worth knowing about because it's pretty cool.
Awesome.
Yeah. So I am excited.
Yeah, great.
I kid.
I can sense it.
But before we do that, we should say if people like starting the year off hearing about individual stocks, Felicity and Candace over on Talk Money to Me have done 22 stocks for 2022. We're only doing 2.
Yeah, I know. Pretty amazing.
Them. Not
Yes.
us.
Yeah. Yeah, pretty amazing. We're getting 2 stocks under. Yeah, go over and listen to Talk Money to Me as they chat about 22 stocks on their watch list for 2022. They're doing a great job over there. And tune into them if you haven't already, as they also do order pad episodes where they deep dive on a couple on stocks that are on their order pad for their clients. So if you do want stock specific stuff, certainly go and listen to Talk Money to Me. But Ren, let's crack in.
Well,
no time like the present.
No time like the present, but we should say on these episodes where we're pitching individual stocks, it's really important to stress that this is not financial advice. Bryce and I are not advisors. We don't know your personal circumstances. We are 2 people who are trying to learn out in the open, who are trying to share our journey, but we are not saying this is a buy. If you'd seen my track record over the last 3 years, that goes without saying, but we should say it.
Yes.
2 companies to add to your watch list to research yourself, but there's so many investing opportunities out there. Do your own research, find your own opportunities. We are entertainment, not advisors.
That's it.
All right.
Let's do it.
Who's going to go first?
You go first.
Okay.
I can't wait. I don't want any more suspense.
All right. So this company is a company that has created $128 billion in shareholder value over the past 2 decades, but only has a market cap of $12 billion.
Wow. What the?
How
does that make sense?
How weird is that?
Yeah.
This company is the anti-conglomerate.
Okay.
We look at someone like Berkshire Hathaway and we see them buying stakes in businesses or buying full businesses, rolling them up into this efficient, well-oiled machine that sits under Warren Buffett and Charlie Munger, and we admire it. This is the opposite of that. This is a company that sucks in little companies and spits out giant world-beating companies.
Really?
This company is IAC, Interactive Corp.
Okay. Haven't
have
heard
you
of
heard
it.
of them?
No.
Well, let me start it this way. Have you ever wondered... Oh, don't look it up on your computer. Let me give you the spiel. No. Come on.
Yeah,
Let me
sure,
give you the spiel.
Sure.
Have you ever wondered, you go on like a random website or like use a random tool online and you wonder who owns that?
Yeah.
Like Vimeo, the video player, or Investopedia.
Mm-hmm. Oh, yeah. Investopedia. That's a good one.
Interactive Corp owns it.
Owns or owned?
Vimeo owned. Investopedia owned. So
Interesting.
what they do, they own, like hundreds of internet businesses, and they roll them up into separate business units, and then they spin those business units out, and they give shareholders of Interactive Corp shares in the new businesses.
All right.
So some over the past 25 years, they've spun out 11 public companies. Some names that you probably are familiar.
And they still hold shares in those companies?
No. So but the shareholders do. It's not like the Coles and Wesfarmers demerger where Wesfarmers hung on to like 20% of the Coles shares. This is like 100%. You're your own company, but if you're an Interactive Corp shareholder, you hold those shares.
I get it. What's the reasoning behind that for IAC?
These companies are just better on their own. Like they can manage their own capital, they can take advantage of their own opportunities.
But I mean, it's an interesting decision for IAC not to want to.
Because it still creates the shareholder value.
Yeah.
Like, so this company is mainly controlled by this one guy, Barry Diller, who I'll get to. But, like if you're an IAC shareholder, whether IAC owns it or whether it's its own company, either way,
it doesn't matter.
You get the shares.
Yeah.
That was the point of the opening. They've created $128 billion in shareholder value, but they're only a $12 billion company.
Yeah.
The value just goes out into the world.
Yeah.
So they've spun out 11 public companies over the past 25 years. Expedia.
Yep.
Heard of it?
Yep.
TripAdvisor, which was actually spun out of Expedia.
Yep.
Match Group.
Yep.
Which we did a summer series deep dive on. Vimeo, the video player. Lending Tree, which is a big online lending business. Ticketmaster, you've probably heard of, since acquired. A number of others. Home Shopping Network, a bunch of others. And then they've also sold a bunch of notable companies. So rather than spun them out, just sold them directly. Newsweek, they owned for a while. Urban Spoon, they sold. USA Network. So like a number of big companies have gone through IAC.
Do they get these companies like in their infancy, turn them into something big, sell them off, or do they create them?
Bit of both. But for example, Match Group, they bought Match.com in like 1996. And then Tinder was actually started at an IAC incubator by a bunch of USC students. But then they bought Tinder later. They bought a number of the other apps. Then they rolled it into this online dating company, Match Group, that then they spun out last year. Yeah.
Wow.
So that's the business model. So let me give you a worked example of how this works in practice. So in 1995, Barry Diller took over the company. It was then known as Silver King. It's since renamed. Then it was trading at $39 a share. So if you bought 10 shares, $39 a share, $390. If you just held those original 10 shares until today, here's what you would own. 10 shares of IAC, 10 shares of Expedia, 4 shares of QVC, 5.5 shares of Live Nation, 0.6 shares of Lending Tree, 21.5 shares of Match Group, 10 shares of TripAdvisor, 6.6 shares of Marriott Vacations, and then you would also have $59 in cash from when another company that was spun out was then since acquired. So all up, at the end of last year, all of those different shareholdings that you would have had from the original 10 shares that you bought would be worth $7,170
from $390.
From $390,
Wow.
which is a compound annual growth rate since 1995 of 12%.
Yeah.
Compare that to Berkshire Hathaway, 10% in that time, or the S&P 500, 7% in that time.
Well, how rich is the main dude?
He's a billionaire.
Yeah.
Yeah. But he's really impressive.
What role does he play?
He was CEO, now he's chairman. But he also is like, he's not majority shareholder, but he's got like a class of shares that gives him a fair bit of power. That's the business model, the anti-conglomerate business model. They exist to buy and build up companies, internet companies, media companies, tech companies, build them up and then spin them off to shareholders. And so some of the companies that they operate now, Angie's Home Services, which is like a online marketplace connecting consumers to home services professionals, kind of like High Pages. Yeah. Dot Dash and Meredith are two online publishing brands, like big portfolios. They own publishing brands including Investopedia, People, Entertainment, Better Homes and Gardens, InStyle, Brides, like a whole bunch of things. Dot Dash has 96 million monthly viewers. Meredith has 144 million. So you can see they're building like a digital publishing business that maybe they sell or they spin out at some point. They've got, you remember Ask Jeeves?
Yeah.
Which is now just Ask. So they have a search business where they own all of those assets. Okay. Don't know what they're doing
Pointless,
with that. Yeah. But it earns a bit of money. Care.com is another online marketplace for caregivers, childcare, senior care, tutoring, housekeeping, stuff like that. Mosaic Group is a web development company. This was an interesting one. So they have 44 branded mobile apps, 3.8 million paying subscribers, but it's all those weird apps that, again, it's like, who the hell owns this? Who the hell makes this? Not like games, but just like strange apps, like, productivity apps and stuff like that. Yeah. They own a bunch of them.
MyFitnessPal and shit.
Yeah. Vivian Health, marketplace for healthcare professionals. Blue Crew, a marketplace for hourly jobs. So it's all these like online businesses that they're trying to build up and scale, and then they eventually sell or spin out.
So it's kind of conglomerate then not conglomerate. Like
yeah. But rather than like keeping them all in-house, they
at some point.
Yeah. Then they also have minority investments. They invested $250 million into Turo, which is a peer-to-peer car sharing marketplace, Airbnb for cars, kind of like Car Next Door that we have here, which filed for an IPO like a week ago. And then they own 12% of MGM Resorts International.
Oh, nice.
The Las Vegas, the global casino operator and the sports book, which we'll come back to because I think that's
the big one,
the interesting one. So that's what the company is now. Management, Barry Diller, said his name a couple of times. Let me introduce you. So he came up in Hollywood, built Fox Broadcasting, was the guy that greenlit The Simpsons back in the day.
Oh, wow.
Then built up USA Network, was the CEO of Paramount Pictures for a while. So like big in like Hollywood media, that kind of thing. Oh, sorry. Yeah. Then CEO of 20th Century Fox. That's when he greenlit The Simpsons. He's on the board of Coca-Cola today, a bunch of stuff, pretty impressive management. And then from 95 has been at IAC doing this thing there. There is literally a term that the media use called the killer dillers. And what that is, in sports, there's like coaching trees. Mm-hmm. Like people in the AFL talk about Clarko's coaching tree, or in the NFL, Bill Belichick's coaching tree. In business management, there's the killer dillers, which is basically all of these executives that he's built up and mentored and trained.
Wow.
Michael Eisner, who was CEO of Disney. Jeffrey Katzenberg, co-founder of DreamWorks. Dawn Steele, who was the president of Columbia Pictures. Dara Khosrowshahi, the Uber CEO, who was a CFO at IAC, and then Barry Diller basically tipped him to run Expedia when it became a public company. Mindy Grossman, CEO of Weight Watchers, a number of others, like all of these incredible executives have come up under him. And so if you talk about like good management and building good management for a lot of these portfolio businesses, he's got a pretty good track record.
Wow.
So that's the business, that's the management, that's the business model. But recently the company spun off two of its best assets, Match Group and Vimeo.
Yeah.
And so then you wonder, why am I picking it for Stock of the Year? Number one, because I just wanted to talk about it and I've got no hope of winning this competition.
Never know, yeah.
But number two, there's a couple of potential catalysts that I think are interesting. So the first one is the spin-offs of Match Group and Vimeo has freed up their balance sheet. They've got about $1.5 billion in cash. They can raise more money if they want to. So they've got some options. But the second one is this MGM stake. So they spent about $1 billion to take 12% in a casino operator and sportsbook operator. The question is why? The expectation is MGM have an online sportsbook that apparently is just not doing that well. It's producing so little revenue that MGM basically round it down to zero. And there's an idea that IAC are coming in to try and do what they've done in a number of other industries and take it from offline to online, consolidate a number of businesses, and then spin it out. So it's a way to play the legalization of sports gambling in the US. They've done this with dating. They got all these online apps, aggregated them, turned it into Match Group. They did it with ticketing. They took it from an offline thing to an online thing with Ticketmaster, spun that out. They did it with travel, took all these this offline business, bought all these online, travel groups, made it into Expedia, spun that out. They're trying to do it with home services now and, tradies and stuff like that with Angie Home Services. And now the idea is that they're doing it with sports gambling. And they're trying to move it from offline to online and consolidate a whole bunch of players. So it's early days, but it's an interesting thematic in the US, obviously, sports books. And there's plenty of ways to play it. You can go, directly to like a pen. You can go in Australia to like a points bet. But this is potentially another way to look at it. The bear case, we should just be clear, is a lot of the businesses that they have at the moment might just be dogs, just might not be that good. Like home services, online publishing, like not exactly the greatest money makers online. Maybe they've spun out a lot of the great businesses, Vimeo, Expedia, Match, that really made a lot of money for them, and what they're left with isn't that good.
Yeah.
So that's the real bear case, that this is so dependent on them being able to continue to do what they've done. Because in the conglomerate business model, you keep the good stuff. In this business model, you spin it out and you rely on your team to find more good stuff.
Yeah.
So
That's fascinating.
Yeah. But really interesting company.
Yeah, really interesting. It reminds me of the one we spoke about last year, the guy rolling up all the really niche software companies.
Oh, Constellation software. Yeah.
Yeah, fascinating. Interesting business model. I'd love to work at a place like that. I think it would be really interesting to try and roll these up, create businesses, spit them out again. Apparently
with Lending Tree, so the story is they brought an executive in to do something with online lending. Oh, wait, no. So not with Lending Tree, with Dot Dash and Meredith. They brought someone in to do something with digital publishing, and he was like, if you want me to do it, he had a look at the market and was like, I need a heap of money to make this Meredith acquisition and roll up a whole bunch of brands. They're like, great, we brought you in to figure it out. Here you go. And so it seems like they get a lot of freedom to build these businesses. Yeah.
Be epic.
So yeah, it'd be pretty cool.
Nice one. So just for those listening at home, it's listed in the States.
NASDAQ,
the ticker is IAC. Yeah, I hadn't heard of it, but truly fascinating. A really good pitch, I think, for stock of the year. Stock of the year. Here we go. All
right. Let's take a break. Let's hear from our sponsors. And then I'm excited to hear what you're going to beat me with this year.
No, I'm not so confident.
All right, Bryce, you've kept the people waiting long enough. What have you got?
Well, it's nowhere near as exciting as IAC. It's a company I love. Everyone would have heard about it before. There's potential that I've missed a lot of the upside on this one. It had a cracker of a year last year.
Tesla.
Along with many other stocks. No, come on. Had a stellar 2021. But I think this is a stock that should perform if a lot of the headwinds we're expecting to see. It should hold up all right in 2022. If we don't see a lot of those headwinds, then I expect it to continue to perform as well as it has over the next 12 months. It's a stock that always under-promises and over-delivers. It's an Australian company every single time. It's very good at keeping the market updated and always beats analyst expectations. And we know that the stock market loves that. No.
Okay.
We know the stock market loves that. And it is a global leader and now one of the world's largest asset managers. Macquarie.
Jeez, how are you going to get 20 minutes out of this?
No. So for those listening who aren't in Australia and around the world, Macquarie is the world's largest infrastructure asset manager. It manages $737 billion in assets under management, but it's also a global financial services group. It's operates in 33 markets around the world, and it has 4 operating groups. As I said, it is one of the world's 50 It's in the top 50 largest asset managers, and it's Australia's fifth largest bank.
You're going to beat me again.
No. As I said, it depends what happens with the market this year. But yeah. So I just want to. I know I've spoken about it a lot, but I just wanted to go through.
And give the description, but also tell us why you've chosen it for this in particular.
Yeah. So it's made up of 4 operating groups. Its operating groups are banking and financial services. So it's retail banking operations, personal banking, wealth management, and business banking. It has about 1.7 million customers in that space. It has Macquarie Asset Management, otherwise known as MAM. It's the world's biggest asset manager, as I said, $737 billion.
No, it's not the world's biggest asset manager.
Infrastructure asset manager, $737 billion. It's got a commodities and global markets arm. And so this is a markets-facing business helping everyone with risk management, accessing markets, execution, just your normal sort of product market. And then Macquarie Capital, which advises companies on growth opportunities, sources investment funds, negotiates transactions, and also spins off companies and lists them on the share markets and those sorts of things. So the investment banking side. 4 areas of the business. If we have a look at the financials, as I said, this is where they continually surprise the market. They had half year to 30th of September 2020, operating income of $12.7 billion. Net income on that was $3 billion, but they've just posted a $2 billion profit in the first half of 2022, up from $985 million in the corresponding period. So churning out cash. And that income is well diversified, which is one of the reasons I like them. They get 34% of their income from the Americas, 23% from Europe and the Middle East, 11% from Asia, and 32% from Australia and New Zealand. So pretty well diversified spread of income from around the world. The reason I like them, though, is because of their change in business model since the GFC hit. When the GFC hit in 2008, it really forced Macquarie and a lot of investment banks to look at their business model, particularly their risk management practices and where they were getting a lot of their revenue from. And this forced Macquarie to change their revenue base, and has subsequently delivered 1,000% increase from the bottom of the GFC 2009 in their share price. So it's been pretty significant return in shareholder value. So what did they do? The bulk of their earnings traditionally came from its market-facing businesses, which was the commodities and global markets and Macquarie Capital. What they then did was change that and so that was a lot of advisory fees and trading desks, so commission-based stuff. 70% of their revenue came from that side of the business in 2014. In 2015, though, they started scaling up what they call their annuity-style businesses, which is their banking and financial services and their MAM, or their Macquarie Asset Management. Annuity-style businesses, for those at home who are unsure what that means, it means they're businesses that generate steady income and are reasonably low risk. And for Macquarie, this means their asset management business, asset financing, and retail banking services. They all produce recurring revenue year in, year out. And as investors, we love recurring revenue. So that's changed how revenue and profit has been broken. And their annuity style activities now account for 63% of their net profit, compared to what it was 30% sort of, 5 or 10 years ago. And their biggest contributor to that is their Macquarie Asset Management, which 10 years ago, as I said, was only 30% of the business. But why am I choosing this for 2022? If interest rates go up, right? Interesting to get your thoughts on this. But if interest rates go up, I feel like they're reasonably protected. There's no doubt that low interest rate environment has supported sort of real assets, their infrastructure funds, their property. But I think the impact of rates, we need to look at where they get their revenue from. And as I said, that is Macquarie Asset Management, their infrastructure funds, and their commodities business. If rates go up, it will pull down the value of assets and reduce performance fees. But the way that they make money in these businesses is off management fees, and management fees aren't based on the valuations of their underlying assets. The majority of management fees aren't based on the evaluations of their underlying assets. So the impact of that will be limited. And on the commodities and market side of the business, it's commission based. So it actually does well when there's a fair bit of volatility in the market. So if there is a bit of a bumpy year this year, you'd expect, a fair bit of trading to go on, and that side of the business should start to see some decent commissions as well. I could be totally wrong here.
Well, the other thing is like the infrastructure assets will probably be able to pass price increases on.
Yeah.
They might be one of the better protected businesses.
Yeah.
Yeah.
Well, I think two main growth drivers at the moment for their asset management business is obviously infrastructure, but also renewable energy. So regardless of what happens with rates this year and whatnot, the asset management engine will just continue to grow, I think, regardless of market conditions, because there's just so much money, institution around the world. There's almost infinite demand for infrastructure investing at the moment. Why is that? They need to put their money somewhere that's going to just be generating long-term consistent returns. You think about all the pension funds around the world that have so much money they need to put somewhere. We've just seen Sydney Airport be bought by pension funds. So Macquarie are really well positioned for that. There's just such huge institutional demand for infrastructure investment. They're really good at raising money. They can raise huge funds, and they consistently do so and consistently churn out pretty decent returns. One other thing that I really like about them as well is their talent. They are known as producing millionaires. They're known as the Millionaire Factory. So they attract talent. They probably have some of the best talent in the business in investment banking and asset management. And they're really good at keeping that talent, primarily because the way that their incentive structures are set up. You get paid bonuses that have sort of 3-year cliffs on them or whatever it may be. You don't actually get to realize the stock options for a number of years, which keeps a lot of their good talent in positions, and they foster talent up the chain. So yeah, I think for me, it's a business that I don't think is going to go gangbusters. It's not your tech stock. It's not your Tesla, but equally, I think it's more of a downside play for me. I think it's positioned well enough. It's got revenue coming from a number of different areas, but the two biggest buckets of revenues, they're asset management and commodities and global markets, which I think shouldn't be too impacted should market conditions become a little hairy. Again, there's probably people listening thinking that I've lost the plot, but for me, Macquarie.
So in the past 2 weeks, they're down about 9%. But I think before that, they were Australia's third largest bank. Like they had just got past Westpac and ANZ.
Wow.
But now ANZ and Westpac have jumped them again. But I think, they're like right in there. Yeah.
Wow.
Good pick. It is.
It's not as exciting as IOC. It's not as
Yeah, but I mean, if you're talking about a company that has just like multiple routes to make money, it's like they literally just have a monopoly on talent from like monopoly on young talent. So if you're a great like a great finance or economics or probably great any student these days, Macquarie get you there, they entice you, and it's where you want to go. And then they lock you into employee share schemes with like 10-year vesting. And the shares are doing so well that like you don't
want to leave. Yeah.
And then they just empower you to just find ways to make money.
Well, I think that's what one of the key things. We know a couple of people who've worked there, and they really just say, go out and make us money.
Yeah.
You have one job to do.
And like you are properly compensated for that. If you can
profit
deliver.
share and
So I mean, if you were to say what's the ingredients for a great business, it's getting the best people possible and giving them the freedom to just pursue whatever they want to do around the world.
Yeah.
And Macquarie sort of built that.
Yeah.
And like you could see plenty of ways where it doesn't work, and there's always risks, but I mean, it's as good a business as you can find, really.
I know. There's just, well, I mean, for me, it's just so much money looking to park it in infrastructure projects, renewable projects, and these guys are the biggest managers of that in the world. It's like
one thing where like you don't want to have an over-reliance on what is fast becoming the hottest asset class in the world. Like the amount of money chasing those assets, renewable energy assets and just infrastructure assets generally, pension funds, like sovereign wealth funds, big fund managers, like everyone is chasing them. And so potentially you get into bidding wars and you spend more than you should on these assets. But then again, like even as I say that, if there was one asset manager that I expected to be disciplined when it came to this stuff, it would probably be Macquarie.
Yeah. Well, there you go. Two, an Australian-based company, a US-based company. That's it. Stock of the year done and dusted. We'll put that away and see how we go in 12 months' time.
Yeah. Just a reminder as we get off talking about how good Macquarie is, we are just two people trying to learn. You've got to do your own research. We've been wrong plenty of times before and we'll be wrong plenty of times again. This could be one of them. So do your own research.
DIYR.
DIY.
Whatever.
We're wrong about that as well.
Ren, always good to chat stocks. I'm hoping to do more of it this year as well. We've got plenty of awesome episodes coming up to kick off the year. We've got Nick Griffin coming back on the show soon to chat about what's going on in his world of investing. Plenty of awesome experts and some EM chat to kick off the year. So it's been a pleasure. Great to be back into it. Exciting start. We'll pick it up next week.
Sounds good.
Equity Mates Investing Podcast is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. Equity Mates gives listeners access to information and educational content provided by a range of financial service professionals. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Equity Mates Investing Podcast are not financial professionals and are not aware of your personal financial circumstances. Equity Mates Media does not operate under an Australian Financial Services Licence and relies on the exemption available under the Corporations Act 2001 in respect of any information or advice given. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast or video. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Equity Mates Investing Podcast acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.